Finovasta. Finance. Innovation. Wealth.
Let's be honest. If you've been watching the news, scrolling social media, or just chatting with friends, crypto can sometimes sound like a sci-fi novel mashed up with a Wall Street boardroom. We know digital assets are completely changing the face of modern finance, but the whole space? It is notoriously overwhelming if you're just getting started. So today, we're pulling our insights straight from the Finovasta Beginner's Guide to Digital Money, and we're going to break this massive subject down into bite-sized, digestible pieces.
We've got a 5-step agenda to get through today. We'll start with unlocking cryptocurrency basics, then look at how the technology works, compare crypto to traditional money, weigh the risks and rewards, and finally, go over your practical crypto starter guide.
Section 1. Unlocking Cryptocurrency Basics. Let's lay down the foundation.
If you are completely new to crypto, this is literally the very first question we need to answer before we even think about looking at any charts, prices, or market trends. What exactly are we talking about here?
Well, here's your foundational definition. Cryptocurrency is a type of digital asset. But wait, unlike the digital dollars or euros you're used to seeing when you log into your banking app, this uses something called cryptography to secure its transactions. So the absolute core takeaway here is that it's digital money operating without a central government or some traditional bank pulling the strings behind the scenes. It is an entirely different technological beast.
Think of it as an incredibly secure, tamper-proof system built on 4 main pillars. First, you've got the blockchain, which acts as a massive global digital ledger recording transactions across computers worldwide. Then, cryptography steps in like a mathematical vault to protect those transactions and prove who actually owns what. Next is your cryptocurrency wallet, which holds the keys, letting you interact with your assets. And finally, decentralized networks. This ensures no single company or bank can just pull the plug, because the whole network is verified by a widely distributed group of participants.
Okay, moving to Section 2, how the technology actually works. Let's look at the tech behind the coin.
Look, you really can't talk about cryptocurrency without talking about Bitcoin. It was the absolute pioneer. Launched back in 2009, right on the heels of the global financial crisis, it was created by an individual, or maybe a group, we still don't know, using the pseudonym Satoshi Nakamoto. And it had one very specific purpose: to let people transfer value electronically without a financial middleman taking a cut or slowing down every single transaction.
$21 million. That is the magic number. There will only ever be a maximum supply of 21 million bitcoins. Period. Because of this mathematically enforced scarcity, combined with its decentralized design, a lot of investors have actually started viewing Bitcoin not just as a payment system, but as a potential long-term store of value. You'll often hear people refer to it as digital gold.
But the technology certainly didn't stop with Bitcoin. Enter Ethereum. Ethereum took Bitcoin's core concept and blew it wide open by building an entire platform for decentralized applications. It does this by using its native token, Ether, to power what we call smart contracts. These are basically automated software agreements living directly on the blockchain. So when specific conditions are met, boom, the contract automatically executes. No lawyers, no intermediaries required.
And really, Bitcoin is just the tip of the iceberg in what is now a massive ecosystem. You've got altcoins acting as general alternatives to Bitcoin. You have stablecoins, which literally peg their value to real-world assets, like the US dollar, to avoid those crazy price swings. There are utility tokens, which kind of act like digital arcade tokens, giving you access to specific functions on a network. And then you have governance tokens that actually give you voting rights on a project's future decisions. They all serve totally different, specific functions.
Before we move on, I want to share a super helpful way to avoid beginner confusion, because these two terms get mixed up all the time. Think of the blockchain as the underlying technology, the highway network itself. The cryptocurrency, that's the digital asset, the vehicle traveling on that highway. You can absolutely have the highway without the vehicle, but the vehicle absolutely needs the highway to get anywhere.
Right, Section 3, Crypto versus Traditional Money. Let's compare these two incredibly different systems.
It's so important to realize that cryptocurrency isn't just a digital version of traditional fiat money. It is a fundamentally different technological system. While your traditional currency is issued by a government and heavily managed by central banks, crypto is largely decentralized. Traditional banking systems have operating hours, holidays, and weekend delays. Crypto networks, they are awake 24/7. But here's the real kicker, and why this matters so much for you.
Traditional banks can usually reverse a fraudulent or mistaken charge. In crypto, once a transaction is confirmed on the blockchain, it is final. Reversals are basically impossible.
So a question that comes up a lot is, why does pure computer code hold any real-world value at all? Honestly, it boils down to a mix of 5 things. Supply and demand dictate the immediate price tag, while utility gives people an actual, practical reason to use it. Add in network effects, which just means the ecosystem gets stronger and more valuable as more people join, structural scarcity, and finally, the ultimate wildcard, market sentiment. A single viral social media post or breaking news article can massively swing investor demand in a matter of minutes. Moving on to Section 4, weighing risks and rewards. It is definitely time to balance the scales.
You have to carefully balance the incredible freedom of this new system against its fairly harsh realities. Yes, on one hand, you get global, 24/7 access that totally ignores borders, total transparency of the public ledger, and the amazing ability to hold your own assets without needing a bank. But the flip side, you're dealing with extreme price volatility, a space that is unfortunately riddled with scams, and that brutal reality we just mentioned: if you make a simple typo in a wallet address, your funds are gone forever.
A prime example of this extreme risk-reward dynamic in action is DeFi, or decentralized finance. This is where developers use those smart contracts we just talked about to recreate traditional financial services. Think lending, borrowing, and trading, but entirely without conventional banks. It's wildly innovative and can offer some incredible financial opportunities. But it introduces significant new risks, like vulnerabilities in the smart contract code itself. Basically, if the software isn't perfectly written, hackers can sometimes swoop in and drain the funds.
Okay, Section 5, your crypto starter guide. Let's get incredibly practical here.
Before you even think about buying a fraction of a coin, you need to know exactly how you're going to hold it. You've got choices. Hot wallets are connected to the internet. They are super convenient for frequent trading, but that constant connection definitely makes them more vulnerable to hacks. Cold wallets, on the other hand, are offline physical devices offering highly secure long-term storage. You also have to choose between custodial wallets, where an exchange holds your private keys for you, kind of like a traditional bank, versus self-custody wallets, where you hold the private keys yourself. This choice ultimately boils down to convenience versus ultimate control. Just remember, if you lose your keys in a self-custody wallet, you lose your crypto.
So if you're ready, here is your safe pathway in. Step 1, educate yourself first. Truly understand the fees, the wallets, and the risks. Step 2, choose a reputable, legally compliant exchange in your jurisdiction. Step 3, secure your account immediately by turning on strong multi-factor authentication. Step 4, start small. Seriously, only invest what you can comfortably afford to lose while you're learning the ropes of a highly volatile market. And Step 5, fiercely protect your wallet and your recovery phrases. Never ever share those phrases with anyone online, period. This quote right here really captures the ultimate takeaway from our Finovasta source material. Cryptocurrency offers incredibly exciting possibilities for the future of digital finance, but a grounded, foundational education absolutely must come before any financial investment. Don't just buy a coin because someone online is yelling that it's going to the moon. Take the risk seriously, learn the technology inside and out, and research the specific projects first.
As this incredibly fast-moving technology continues to reshape global finance, the opportunities and the risks are going to scale right alongside each other. So the most important question isn't what the price of Bitcoin is going to be tomorrow. The most important question is, will you take the time to truly understand the mechanics before you make the leap?